The United States has passed through a period of wage stagnation, and the impact that it has spawned for millions of American families has turned out to be one of the most important economic challenges in the last few decades. In spite of the growth in the economy and numerous advances in productivity, wages for most workers have not kept pace with the rates of development. This has left families reeling with financial stress as they are unable to meet their standard of life. Workers' inflation-adjusted earnings had hardly budged since the 1970s, and especially for workers with low and intermediate incomes. For example, output in the United States increased by almost 62% between 1979 and 2021. The hourly compensation of the median worker increased by only about 17% over the same time. This difference illustrates the extent to which the income increases generated by productivity growth have failed to raise the wages of most workers. Rather, the gains have largely flowed to corporate profits and the highest income individuals, who have resulted in an increased gap between the richest Americans and the working class worker. This is a part of a greater pattern where costs of living have shot up, particularly with housing, healthcare, education, and childcare straining household budgets. The price of a house, for instance, has risen almost 3/4 of a cent in the past 2 decades, especially in towns where job opportunities are always centralized. Between 2000 and 2020, the prices of houses increased by about 82%, while median household income rose by just about 27%. This has the result that now many families are spending more than 1/3 of their earnings on housing alone, which economists would believe to be unsustainable. Healthcare costs have also shot up, with the average annual premium for family health insurance now over $22,000. This is one figure that rises with each passing year and consumes an increasing proportion of budgets that are already stretched to the limits of a family. Education in recent years has gone from being a means for a safe and more upper-class profession to a real financial burden. Since the 1980s, the cost of attending college has more than doubled. Its fees have similarly increased, with devastating effects on families which can hardly do otherwise than take on large debt obligations in order to fulfill them. In fact, the student loan debt situation in this country is already beyond $1.7 trillion wide, showing obvious discrepancies between stagnant incomes and continually increasing cost of schooling. In essence, parents will always struggle to help their children get financial aid for education. Since this is not easy when your earnings cannot cater to 2 needs, the urgent of the family and the less urgent one of funding further education. Another expense that has become one of the major expenses for most parents in childcare. In some places, full-time childcare expenses equal or even surpass those for college. The inability to afford childcare greatly limits the choices families can make and often means one parent must stay at home, which decreases that family's overall income and potential success. Beyond the immediate pressure on one's finances, wage stagnation has a far-reaching influence. It's becoming less easy for families to place savings to help in old age. The average American close to retirement age has saved just over $100,000, mere percentages of what experts estimate as a requirement to retire comfortably. Without saving money, families cannot amass wealth that can be tapped into for generations. This has been one of the pillars in building financial stability and mobility for generations. More households are becoming challenged to fill gaps in income by using credit cards or loans. This has resulted in household debt that is extremely high, thereby negating financial security and reducing future options. Because of the debt cycle, often caused by flat salaries and rising expenditures, families end up with almost no disposable cash for the purchase of property or education, hence perpetuating economic problems generation after generation. Not only has wage stagnation led to a smaller middle class, but it also contributed to an increase in economic inequality. Since the 1970s, there has been a significant widening of the income gap between the top 1% of earners and the rest of the American workforce. For example, today it is commonplace for the average CEO to take home more than 300 times what his common employee earns. For comparison purposes, 50 years ago, the ratio was almost 30-1. Such income imbalance impairs the middle class, often the driver of the economic strength of the United States. Some stability and resilience are lost to the economy with a decrease in numbers that can afford the living costs of the community and take part in investing in local businesses, communities, and services. Among the reasons for slow wage growth are union membership and labor rights have contributed to the weakening of the ability of workers to negotiate for higher salaries and better benefits. This is in contrast to the middle of the 20th century, when unions led the fight for increased wages among the working class. From above 33% in the 1950s, unionization among American workers has reduced to a paltry percentage of around 10% today. This trend has made the firms reduce benefits and pay without much criticism. This is also due to globalization that has seen more work outsourced to cheaper labor nations. Even though this shift has led to reduced prices for goods, it has also led to lower wages in the United States, especially in manufacturing and other sectors that previously served to provide steady jobs with middle incomes. Another essential aspect is the new technology. This shift in the labor market primarily impacted low-skilled jobs that were more routine-oriented. The discovery of the use of technology resulted in creating high-wage jobs in sectors like engineering and programming. However, a vast chunk of the workers who became jobless lack education as well as required skills. Therefore, they end up getting jobs that pay lesser amounts with fewer benefits. Meanwhile, as the gig economy has expanded, so have part-time or contract-based jobs. In this type of job, full-time employees are often stripped of benefits and job security. There has been no upward revision in the federal minimum wage, which is the other cause that has seen income not grow for the lowest earnings in the country. The federal minimum wage has been fixed at $7.25 per hour since 2009. It is a rate that neither keeps pace with inflation nor with the cost of living. This minimum wage has been enforced since 2009, but millions of workers work in jurisdictions where they have to settle for the federal minimum wage, which drastically reduces their purchasing power and restrains them from keeping up with rising prices. There are enormous psychological costs of wage stagnation. Mental illness, depression, anxiety frequently accompanies insecurity in one's financial standing. Mental illness can also strain relations within a family and jeopardize children's well-being. This chronic pressure over having that amount of money to pay debts will take a toll on all facets of life, from relationships to health. The struggle itself can make financial troubles even more difficult for families, inasmuch as that the medical expenses, other bills will also await them. Chronic financial stress might even lead to physical health issues. Finding full policy remedies will be a precondition to solve wage stagnation problems. The federal minimum wage can be increased to a living wage plus inflation and cost of living regional differences. With this adjustment, a high proportion of families would be taken out of poverty, with the income gap reduced significantly. Workers may be given the power to negotiate fair salaries and wages if labor safeguards were better and attempts to unionize were encouraged. Such would reduce this gap between productivity and compensation. Tax reforms could also solve the wage stagnation problem. For instance, increasing the levels of taxation on higher income and businesses can go on to support social programs such as schemes meant to reduce income disparities aimed at uplifting low-income working families. The EITC for low-income working-class families can also increase the money available to families, and thus by reducing the constraints faced from the money they initially were having. Other economists believe that there should be legislation that ensures the earnings from corporations are not only utilized for shareholder rewards, but also to help workers. An example of such a policy would be the legislation that mandates a certain percentage of profits for salary increases or employee benefits. The last point to consider is that lowering the prices of healthcare and daycare will immediately help families manage two of their biggest expenses. Families may find relief from rising premiums and medical costs if healthcare becomes cheaper. This may be done through government programs, expansion, or reforms that can reduce the money people have to pay out of pocket. The stagnation in wages has far-reaching negative impacts on almost every other aspect of family life, financial security, mental health, and even long-term opportunities for economic growth. Without collective action to counter the underlying causes of the problem, wage stagnation will be likely to continue eroding the financial security of American families and further exacerbating intergenerational social divides. Economic policies that support fair wage growth, affordable vital services, and pathways to upward mobility can restore the financial health and resilience of families. It is then possible for a society to become more equitable and affluent. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.